So, good afternoon, everyone, and apologies for the slight delay in kicking off this afternoon. Welcome to the monthly Eurosif Sustainable Finance Update. As always, thank you for joining the session today. We have quite a number of notable developments to cover this afternoon. It has been yet another busy few weeks since our last update. But having said that, I hope everyone can look forward to a nice summer break in the weeks to come. Incidentally, this will be the last Eurosif update before the summer. There will be no sustainable finance update during the month of August, as we anticipate many people will be enjoying a well-earned break, and that will include some members of the Eurosif team. So that, of course, means that after today, the next update will be on Thursday, the 1st of September, 2022. But with that said, let's take a quick look at our agenda for this afternoon. So the developments we'd like to cover today are the following. We'd like to give you an update on the outcome of the vote on the Complementary Delegated Act, or CDA, including gas and nuclear activities in the EU taxonomy. Then we will move on to the CSRD and provide you with an overview of the final provisions, which were recently agreed upon by the co-legislators, the Council and the European Parliament. We'll then move on to ESG ratings and provide you with an overview of the findings of ESMA's call for evidence from earlier this year. And then finally, we will do a little promotion of our recent policy recommendations on SFDR, which we recently published and presented to EU policymakers. Throughout the updates, we would welcome any questions you might have. There should also be time at the end for a Q&A. But as always, we may have to proceed with some of the updates if we're short on time. Also, the slides will be made available on our website after the session today, and you can play back this session on the Eurosif YouTube channel or share it with colleagues if you wish. So with that all said, we can move on to our first item on the agenda. So as many of you have probably seen, yesterday during the plenary of the European Parliament, a majority of MEPs decided not to object to the Complementary Delegated Act, or CDA, including natural gas and nuclear energy in the taxonomy. So there was a vote on a formal objection. 278 MEPs voted in favor of the objection, while 328 MEPs voted against the objection, with 33 MEPs abstaining from the vote entirely. Now, in order for the objection to have carried, a majority of 353 MEPs would have had to support the objection. And clearly they were well short of the required majority. Now, you will probably recall that the resolution to object to the CDA that was tabled at plenary yesterday was tabled following the outcome of the joint Econ-Envy committee vote to reject the CDA on the 14th of June. So that's just a word on the background to yesterday's vote. Now, it was the last opportunity for the inclusion of gas and nuclear in the EU taxonomy to be opposed yesterday. And given the outcome of the vote, the CDA will now almost certainly pass into law, and gas and nuclear projects satisfying the technical screening criteria will be considered as transitional activities. Now, we have to confess that the outcome of the vote was more difficult to predict as the date of the vote drew closer. The debate over whether to include gas and nuclear in the taxonomy has intensified quite dramatically in recent months. Not only did opposition to the CDA stem from concerns that gas and nuclear do not technically qualify as transitional activities in accordance with Article 10.2 of the taxonomy regulation, but also increasingly following the Russian invasion of Ukraine, there were concerns that the CDA might potentially increase Europe's reliance on gas, something that may not be prudent from a geopolitical standpoint at this juncture. Now, the legal eagles among you will recall that on the technical point, Article 10.2 of the taxonomy regulation, there's clearly a stipulation that transitional activities contributing to climate change mitigation only qualify as such if there are no technologically and economically feasible low carbon alternatives. Arguably, when it comes to gas and nuclear, there are technologically and economically feasible low carbon alternatives. The reason we mention this legal point is that, of course, now following the outcome of yesterday's vote, Luxembourg and Austria have stated or previously stated their intention to challenge the legality of the CDA before the European Court of Justice if it were adopted, which is now increasingly likely following the vote yesterday. So a number of non-government organizations have also threatened to challenge the CDA in courts. And accordingly, it may be subject to more than one legal challenge in the coming months. Now, that case would be very interesting to follow, very difficult to predict what the outcome would be, and what the determination of the ECJ would be as to the legality of the CDA. But more immediately, from our perspective, representing sustainable investors, now that gas and nuclear will be included in the taxonomy, there is a need to develop additional taxonomy-related product disclosures under SFDR, just to ensure that investors are made aware of exposures to gas and nuclear projects. Now, you may recall that the European supervisory authorities have already received a mandate from the European Commission to develop these additional disclosures. And the ESAs are expected to deliver the additional taxonomy-related disclosures before the 30th of September 2022. And the reason to deliver them by that time is, of course, so that they can be incorporated into SFDR disclosure templates before the templates come into widespread use at the start of 2023. In addition, of course, in the context of the EU Green Bond Standard, there's now a need for additional disclosures to be included to ensure transparency around use of bond proceeds to fund gas and nuclear projects. Now, at this point, it should be pointed out that the European Parliament position on the EU Green Bond Standard currently envisages adding these disclosures in anticipation that the CDA would be adopted. So I think with that, we can open the floor and see whether there are any questions at this point. And if not, we can move on to our next update. But I'll give it a moment to see if we have any questions. Does not appear so. So if anyone has questions on this, please feel free to. Oh no, we have one question. Pardon me. So if I understand this question correctly, the question is whether there will be a requirement to publish 2 EU taxonomy alignment numbers in your disclosures. I do not believe necessarily that will be the case, but there will be quite prominently in disclosures a section whereby you have to indicate what proportion of your taxonomy aligned investments constitute exposures to gas and nuclear. And so effectively, there'll be a special section in the disclosures where you have to say, among my taxonomy aligned disclosures, there is X% that are gas and nuclear investments. At least that is based on what I've seen so far of the additional disclosures being developed by the ESAs. So I think we'll leave it at that for questions on this point for the present. And I will pass you now over to my colleague, Viviana, for an update on the CSRD. So with that, Viviana, the floor is yours.
Thanks so much, Hugo. So now I think I will guide you through the update on the Corporate Sustainability Reporting Directive, so the CSRD. So after our last update in June, there were other 2 trialogues, and one there was on the 14th of June, and the last one actually on the 21st of June, where actually both the Council and the European Parliament reached a political agreement on the final text of the CSRD. So just to recall, the CSRD amends the Non-Financial Reporting Directive, so the NFRD, and introduce more detailed reporting requirements and ensure that these large companies are required to report on sustainability issues. So the CSRD in this way will ensure that financial market participants have the data and they need to make well-informed investment decisions. The text of this political agreement is actually already available on the Council website, but it is not definitive, but just because there are numbers of edits on the legal and on the linguistic point of view, so there will be lawyer or linguistic lawyer actually that they need to check and do some revision of the text. But anyway, the content is definitive and the text will not be changed. So now actually the European Parliament and the Council will have to formally approve the agreement before it is published in the EU official journal. And on the Council side, on the 29th of June, the COREPER, that is the meeting of the all EU ambassadors, approved the political agreement on the Council side. At the next steps in this really final part of the process, the EP Legal Affairs Committee, that is the one that was responsible of the file of the CSRD, is expected to vote on the provisional agreement on the 14th of July. And after that, so just the final step is that it will enter into force 20 days after the publication, and its provision will have to be integrated into member state national law after 18 months. So after this small explanation of the final process of the CSRD, we can now focus on the key contents of the text. And actually there are 4 main elements, we can say, that are particularly the elements that were discussed until the very end during the trialogue. And I think the first one will be the scope. So the CSRD will actually apply to all large and all listed companies with more than 250 employees. And one additional thing is that they will be also responsible for assessing the information at the level of the subsidiaries. And this means that the information regarding individual subsidiaries has to be published in case of significant differences with the group or other subsidiaries. And actually these significant differences, the Parliament and the Council decided that in principle will be defined in the concrete standards. So we will talk more about that. It will be like the role of the IFRAC to explain these significant differences. In addition to these all large unlisted companies, also all listed SMEs. This was one of the main issue during the trialogue, but then there will be an opt-out from reporting requirements for the SMEs for a 2 years transitional period. And last but not least, also the non-EU companies, but just the one generating a net turnover of 150 million euros, in the EU, with at least, of course, one subsidiary or branch in the EU. So these more or less will be the companies that will be subjected to the CSRD. The second element, also this one really important, are the development of the standards of the CSRD. And also in this case, the Council and the Parliament agreed that will be the IFRAC, the authority in charge of setting up the European Sustainability Reporting Standard. And the standard will be built, in any case, as much as possible on existing international standardization, or in order to have anyway an alignment with international standard. And after that, the IFRAC will submit the first standards to the Commission, and will be the role for the Commission to adopt these standards as a level 2 delegated act. And it was also decided that the first set of standards would be published by the Commission by the 30th of June 2023, while the second set and alter sector-specific standards 1 year later, so by the 30 June 2024. Then we can pass to the third element, still very discussed during the trialogue, the element of the auditing session, like part of the CSRD. And it has been decided that sustainability reporting must be certified by an accredited independent auditor, who must ensure that the sustainability information complies with the certification standard that have been adopted by the EU and in the CSRD, and the standard developed by the IFRAC. And this process of accreditation for non-financial auditors and assurance providers can be carried out in one of the member states. So it will be something at national level, but then these process should be, like these auditors should be allowed to operate in any other countries in the EU. As we also said that the scope will also cover the non-EU companies, also in this case, the reporting of non-European companies might also be certified, and could be either by an European auditor or by one established in a third country, but at least should be certified. So in this way, thanks to these elements, the financial and sustainability reporting will be more or less on the same level, and investors, thanks to that, will finally have access to reliable, transparent, and comparable data, thanks to this certification of sustainability reporting. The last element, but not least, is the timing. So the phase-in of these reporting, of this requirement of sustainability reporting, they, of course, like the Council and the Parliament, opt for a more gradual approach to reporting. So the first reports are expected to be published in 2025, but for the financial year 2024, that means that they need to report on that year to publish the report in 2025, just for companies already covered, already subject to the NFRD. While 1 year later, so in 2026, for the financial year of 2025, for other large listed and not listed companies that were not already subject to the NFRD, and still 1 year after, in 2027, for the financial year of 2026, for all listed SMEs, but still here, there will be like more lighter approach, which we already said during the element of the scope, with an opt-out for 2 years, depending on the characteristics of the SMEs. And then there will be also a different phasing for the non-EU companies, that it will be obliged to publish the report on sustainability reporting from 2029 for the financial year of 2028. So with that, I can stop here and I can open the floor for some questions. I think there are also other questions on taxonomy. I think maybe my colleague Hugo will address them in a moment. With opt-out, it means that they can wait until 2029. Yes, it will depend on the characteristic of the SMEs. It will be a lighter approach for the phasing of the SMEs. It will really depends on the characteristics of the SMEs. They could start like all the others, so in 2027, but they can also do it from 2029 if they have some issue or for them it's too difficult to start reporting like following the CSRD in that year. I will wait a little bit more if maybe there will be more questions. Let me know if Hugo, you would like to address the other question. I will pass the floor to Federica, our other colleague, as you wish.
Thanks very much for the update, Viviana. And I think we'll address some of the other taxonomy related questions at the end of today's session. So with that, I think we can pass over to Federica for an update on the ESMA call for evidence on ESG rating. So please, Federica, go ahead.
Thank you, Hugo and Viviana, for your updates. On the 21st of June, the ESMA, which is the European Securities and Markets Authority, wrote a letter to the EU Commission to brief on the key results of its call for evidence on the nature and scale of the ESG ratings market in Europe. The call for evidence was run between February and March this year, following a specific request of the EU Commission. So maybe a brief background can be useful at this point. There is an increasing interest amongst international, EU and national regulators and supervisory bodies to assess whether there is a need for specific regulatory intervention in the area of ESG ratings and data products, and specifically to address issues such as transparency on methodologies and conflicts of interest. So there is a growing interest of regulators and supervisory bodies, also because the importance of ESG ratings and ESG data is increasing in the sustainable investment market, and more broadly in the sustainable finance industry. So we saw a number of publication and actions in the last few months. Just to name a few, in autumn, the IOSCO, which is the International Organization of Securities Commission, following a public consultation, issued a list of recommendations and advocates for regulatory intervention on ESG ratings and data. And in April, June, so just some months after the ESMA, and this year, the European Commission conducted a public consultation on ESG ratings, and now it is expected to conduct an impact assessment by the end of this year, and a regulatory proposal is expected to be published by the beginning of 2023, so next year. So now let's go back to the results of ESMA's call for evidence. So just some preliminary data. The call for evidence targeted 3 categories of entities: the providers of ESG ratings, the users of ESG ratings, such as, for instance, the asset managers, and the rated entities, which means, for instance, the companies that get ratings. During this update, we will focus on results concerning providers and users, but you can access the letter and the main results, which are outlined in the text on ESMA's website. And also, if you follow Eurosif social media channels, you will find updates on that. So ESMA received more than 150 responses, the majority of which are users, 75. Then we have the 34 ESG rating providers and 47 rated entities. So based on the information collected through the responses, ESMA concluded that 59 ESG rating providers are currently active in the EU market. So if we look at the main results concerning ESG rating providers, ESMA's main observation is that there is a small number of very large non-EU providers. Which means providers which are not headquartered in the EU, but of course have offices of operations in the EU, and a large number of significantly smaller EU entities, which means EU companies, which can be classified as medium or small companies. So if we look at the location, almost 90% of providers, or at least the providers that have responded to the call for evidence, have legal entities or corporate headquarters located in the EU. And of the respondents located in the EU, the majority of their headquarters and or legal entities in Germany, Italy, and France. So they're concentrated in some countries. So if we look at the revenues, the annual average revenue of respondent for 2020 amounted to around 23 million euros, but the median value, so the middle number, if we consider the sequence of revenues, is much lower, around 5.5 million. And these figures indicate a relatively large number of providers with small revenues. So looking at the business model, the predominant business model is an investor pays model, which means that users, for instance, investors, pay providers to access the ESG ratings. However, ESMA points out that 1/3 of respondents say that they issue ratings based on an issuer pays model, which was a higher rate than regulators expected. So issuer pays model means that the entities which are evaluated and rated, for instance, the companies, pay the providers to be rated. So the predominant model is investors pays model, but ESMA found that some ESG ratings are provided based on issuer pays model to a higher degree than what was previously expected. Another final interesting data on providers, more than 70% of respondents among providers also offer ESG data products. So we are not talking about ratings, so evaluations, but ESG data products, which are also increasingly important in the market. So now let's look quickly at the results on ESG ratings users. So based on the data on assets under management and assets under administration, ESMA concluded that respondents include smaller and larger asset managers. And this is interesting. The dimension can be relevant and influence the type of use that asset managers make of ESG ratings, thus influence their needs and expectation relative to ESG ratings. So of course, the quality and the type of responses provided also are dependent on can be or might be dependent on the dimension. For instance, asset managers can differ on resources and expertise available for ESG analysis, and that influence the response that it might give, for instance, on the clarity of the methodologies, but we will see it in a bit. Regarding the relevance of ESG ratings in the investment process, so how much they are important and used, ESG ratings and other ESG data products are inputs in the investment decision-making process of almost 4,000 euros investments, which means roughly half, 48% of total assets under management, of course, based on respondents among users. It is also interesting to know that the share of investments for which ESG ratings and other ESG data products are used as input varies widely across respondents. So there are respondents that have 0% and respondents that have 100%. So this provides us a very interesting input, meaning that ESG, the asset managers vary a lot in the use and the importance of ESG ratings and more broadly on ESG data products. Another important point, asset managers tend to buy ESG ratings from multiple providers, and basically for three reasons: to increase the coverage, either by asset class or geographically, to access different nature of ESG assessments, and to obtain information that allow them to comply with different regulatory requirements. So if we look at what investors are looking for, what are the most important characteristics of ESG ratings that investors look for, we can see that the most coveted attribute in the offer of an ESG rating provider is the depth and breadth of data coverage. So more specifically, the choice tends to fall on providers that offer more accessible and complete analysis, not only in terms of type and number of companies assessed, but also importantly on the variety of the key performance indicators that are considered in the evaluation. Quality and transparency of methodology as data is mentioned as the second most important characteristics. And also another important point is the market relevance of an ESG rating provider. So users tend to prefer larger and more mature providers for two reasons. First, the usability of data and ratings is higher and allows for more comparability in the industry. And second, users tend to adapt to the preferences of their clients, which means asset managers tend to follow the instruction or preferences of their asset owners, which might match with the most relevant providers in the market. So these results tell us that users tend to revert to a smaller number of larger ESG ratings providers for the reasons that I just outlined. So in terms of shortcomings identified very quickly, the most common shortcomings are lack of coverage of specific industry or type of entities, for instance, SMEs and non-listed companies, and insufficient granularity of data and too high complexity of lack of transparency around methodologies, and a low transparency on methodologies and data sources. Another challenge identifies the lack of comparable and standardized data, and also asset managers are making efforts to understand the correlation between ESG ratings, and sometimes they found misalignment in the definition of some concepts, like for example, the ESG. Just to conclude, there are a number of interesting points, but I will just quickly come to an end of this presentation. Just to say that it seems that users have transparency issues also regarding the minimum term and fees rates of ESG data and rating contracts. So for instance, users contracting for the same ESG products may be contracted under different contractual terms. So this is also an issue that has been identified. So which conclusions can we draw? In general, respondents among users are strongly in favor of the EU considering regulatory measures to limit the mis-selling and misuse of ESG ratings, and HESMA used these results to draw conclusions on the relevance of the market of ESG ratings and the financial industry, which is defined as immature but growing market. So methodologies still need to be perfected and developed, but there is a growing interest and importance of this market in the sustainable finance industry. And finally, as we saw in the results and the data that I have just presented, there is a large number of smaller and specialized EU providers, and a small number of larger non-EU providers with a broader offer. So I will now give the floor back to my colleague Hugo, who will present us the main recommendation that Eurosif just published on the SFDR. And of course, I will be more than available to respond to any questions at the end of the session. Thank you.
Thank you, Federica. Very comprehensive update. So now, just as our sort of last item on the agenda, we wanted to maybe draw everyone's attention to a report that Eurosif recently published on the 28th of June, which accounts for developments in the EU funds market since the application of SFDR in March 2021. In particular, trends around classifying products as either Article 8 or Article 9. And our report contains a number of policy recommendations to address some of the challenges that financial market participants have encountered when applying SFDR, and particularly around this issue of product classification. So, of course, I'm sure as many of you are aware, since the application of SFDR, Articles 6, 8, and 9 have really entered the lexicon or the vocabulary of the industry. They have become a point of reference and almost in some cases a label of sorts for products. Using or referring to a product as Article 6, Article 8, or Article 9 can give some indication that it pursues sustainability or considers sustainability factors to some degree or another, or to varying degrees of ambition. Now, of course, this is one of the main issues that we've identified when it comes to accounting for trends since the application of SFDR. Technically, of course, Article 8 and 9 merely stipulate disclosure requirements. But I think it's fair to say that whatever the technicalities, Article 8 and 9 have now come to signify more in the market. And they're perceived as products with some level of sustainability ambition. Accordingly, we're conscious that a lot of market participants have come under a degree of pressure to offer largely or mainly Article 8 and 9 products. Now, the challenge seems to arise in that there is a lot of legal uncertainty as to when Article 8 disclosures in particular should apply. Of course, SFDR was conceived of as a disclosure framework, and the goal of the regulation was to bring transparency to the market. And so you could say that, theoretically, having Article 8 and 9 applied very broadly by financial market participants is actually a positive outcome, because, of course, the disclosures will apply very broadly. And then, of course, there'll be a lot of transparency brought to the market. However, from the standpoint of legal and compliance departments in a lot of market participants, it's been very difficult to determine with any certainty when they should place a product into the Article 8 category, or when they should place it into an Article 9 category, leave it in Article 6, etc. And what we've seen, given the lack of clarity, is that market participants are interpreting these provisions very differently. And so the Article 8 category in particular is very heterogeneous. In some instances, you have products merely performing ESG integration, being classified as Article 8. And in other instances, you have Article 8 products which are very ambitious, which have a clear desire to have a positive impact on a sustainability factor. They may make use of PAI indicators, they may conduct engagement, have an extensive range of exclusions, apply a best-in-class approach, investment strategy, etc. So the question we ask in this report is really whether Article 8 should be this broad and heterogeneous, particularly if there is some sort of benefit from one's product being classified as Article 8. Moreover, of course, we feel strongly that market participants would appreciate maybe more legal certainty as to when it comes to classifying a product and thus applying the disclosures. Another issue we've identified in relation to Article 9 is quite fundamental. It's the definition of sustainable investment provided by Article 217. Our assessment is that the definition is very vague, and indeed, as a consequence of that, it has been interpreted and applied very differently by market participants. And so that means that when you consider the fact that MiFID II requirements on assessing client sustainability preferences will come into effect in August, one of the MiFID criteria is the share of sustainable investments. Products will be compared directly to one another based on their share of sustainable investments. However, those products won't actually be comparable because, of course, the concept of sustainable investment is interpreted very differently depending on the market participant you speak to. And so we see here quite a significant risk of greenwashing arising, because greenwashing itself as a term is quite subjective at this juncture. But ultimately, if a client or investor is confounded or surprised by a market participant's interpretation of sustainable investment, this could trigger potential greenwashing allegations or mis-selling claims. Particularly if they discover that the definition of sustainable investment is being interpreted differently by different market participants. So we see this as quite a significant risk for the industry. We've drawn this to the attention of the European Commission. Our policy recommendations effectively propose targeted changes to the regulation that would, just bring more clarity to these product categories and ensure that market participants can classify products in a consistent way without the fear of their interpretation diverging from others and potentially then triggering any mis-selling claim or any allegations against them. So we would very much recommend you to read the report and policy recommendations. It's quite digestible. We presented it to Commission officials 2 weeks ago, and they were very favorably disposed to the report. And so, we'd like to take this opportunity to promote it. And it's available publicly on the Eurosif website. So we'd be very keen for you to read it and, of course, provide us with any feedback or comments you have. As of course, it's an evolving debate. But I think with that, we can conclude this last item on the agenda and allow maybe 5 minutes for questions, because I realize we're a little bit over time. But I think first, maybe the first question to begin with is someone has asked, what generally is the waiting period between when a piece of legislation has been agreed and then ratified, as it were, or approved by the co-legislators, and then it actually being published in the official journal? There isn't really a precise answer to that question, because a lot depends. There's a few variables that determine, how long it takes. At this juncture, probably after the 14th of July, what will happen is the final text of the CSRD will go for translation into all EU official languages. And that is a process that can take quite a long time. And then, of course, once translated, there has to be additional legal checks to clean up the text in each language. So that is a process that can take a few weeks. And given that we're just on, we're approaching summer, there may be a delay because, of course, in August, Brussels shuts down and everyone goes away on holiday. So it's quite difficult to judge at this point, but likely it'll be September or October when it's published in the official journal. And at that point, then member states can start transposing it into national law, and they've been given quite a lengthy period of time to do so. I think otherwise there was a question I just wanted to come back to on the taxonomy and whether when it comes to disclosures of taxonomy alignment at product level under SFDR, other transitional activities in the taxonomy are also subject to kind of a specific disclosures. And the simple answer is no. It's, of course, gas and nuclear will be included in the taxonomy as transitional, but unlike all other transitional activities, market participants will actually have to specify that, gas and nuclear exposures exist. So otherwise, if it weren't for these additional disclosures around gas and nuclear, any investments in gas and nuclear would just be considered alongside all other transitional activities. You wouldn't specify, but they are being treated somewhat differently to other transitional activities. So I hope that is clear. And then I think we have a question on whether there are any sanctions currently for data providers if they publish erroneous or misleading data. So I may pass back to my colleague Federica just to answer this last question. And then I'm afraid we haven't been able to get to a lot of the questions, unfortunately. But please, feel free to follow up with us. We do try and get back to as many of you as possible, but sometimes, it's not always possible to do so promptly. But Federica, would you like to just respond to that question on whether there are any sanctions in place currently for data providers if they publish erroneous data?
Thank you, Hugo. At the moment in the regulatory framework, in the EU regulatory framework, ESG ratings and data providers are not subject to any regulation, but I would just add that methodologies are still under development. So there may be a lot of divergence and lack of correlations also between data. It is very difficult at this stage to understand really what are the truthful and meaningful data. So there is also a need for regulation, but also a need for improvement in the market. Thank you. I will hand you back on Hugo to do the final greetings.
Thanks, Federica. So yeah, that I think concludes our session today. So thanks as always for joining, and we'd like to take this chance maybe to wish everyone a very pleasant summer break. So it's been a busy period up to now, so I'm sure everyone is looking forward to a bit of a holiday, as is the Eurosif team. So we'll say thank you and see you in September for the first update after the summer break. So until then, we wish you all the very best. So thank you very much.